Welcome everybody to our final episode of AngelNV for this iteration 2021-2022. Tonight we're going to talk about deal terms and terminology. I'm going to grind through and read to you 40 slides word for word. I'm going to just read them off the slides. Kidding. There are about 40 slides, but I guarantee you we're not going to hit all of them. I'm going to hit the highlights and see what kind of questions everybody has. It's a really important topic for founders, especially to understand how angels think about deals and how they're constructed. And it can seem a little mysterious, but it's not that mysterious. I'm going to be referring to some terms and terminologies in a couple of books along the way. One of them that's helpful to people, this is sort of the 101 version, term sheets. It's a little book. You can see how thin that thing is. You probably get through it in about an hour and a half. Another companion book that goes with it is this other one called Startup Valuation. Again, teeny tiny little book. There'll be a slide on this at the very end. And then the master plan for all of this is Venture Deals by Brad Pelt. I don't have that with me. It's at my home office. But if you're looking to do a little bit more deeper reading on this stuff, grab a copy of Venture Deals by Brad Pelt. It's got all of this in probably way more detail than you ever wanted to know. At least at this stage of the game. So again, thanks everybody for coming out. I'm going to start with a few thanks to our sponsors and other folks who have helped us put this on this year, and then we'll jump right into the content. So first, I want to say thank you and encourage everybody. If you are a founder and you are looking for some credit outside of what you can do personally, I'm going to encourage you to check out the Brex card at this link you see here, brex.com/startupnv. You get a $500, you get an extra $500 in your card account, and it does not rely on your personal credit. So check out their terms and conditions and how you go about doing that. Also, I want to thank the City of Las Vegas. They do a lot for us. They give us this fabulous facility that we're in here tonight, and where we run our operations from in Southern Nevada. Thanks a lot for loaning us this site and providing some financial backing to allow us to put this on. And last, but certainly not least, is Glassboard Technologies. It's the technology that we actually run our angel fund on. So if you do have an angel fund, or you are an investor and are curious about how you put together special purpose vehicles to do these kinds of investments that we're talking about, check out Glassboard Technology at glassboardtech.com. They do a great job, make it really easy for investors to sign on and sign up to be an investor. And if you're a founder and you're looking for a way to put together an SPV, SPV meaning special purpose vehicle, check out Glassboard Tech, or if you have questions about how it might work, just reach out to me or Logan or somebody else. We'll give you the rundown. As far as what StartUpNV does, we run an incubator and accelerator. We're a nonprofit, we run the program statewide, and we really kind of divide it into three sections. Our founder bootcamp, which you're in right now, seeks to address the basic questions. So what do angels want to invest in my company? And we break that down into 12 Tuesday night sessions over the course of time from October through the middle of January. After you've kind of graduated from that or have the subject matter down, we also run an incubator for companies who are in the feasibility part of this graph here, where you're kind of in between idea and maybe you haven't quite got your product to an MVP or version 1 or beta. Our GrowNV incubator seeks to help founders and startups that are on that part of their journey. Once you get to the point where you actually do have an MVP or a version 1.0 or something that you're selling or about to start selling in the marketplace, we think of that as sort of being eligible for capital, at least in terms of the funds that we run. So when you do reach that point, please pitch to us at StartUpNV. We do invest $50,000 in companies that we believe we can help, and then we take you down the path on the viability part of this graph that gets your product out in the market, build you a nice middle six-figure top line number, which puts you in an ideal spot to raise that very next round of capital, seed round. So check us out at startupnv.org, and you'll get lots more detail than you see on this slide. So does it work? What kinds of activity have we seen? You can see some of the stats here. A little over 700 pitches that we've heard since we started this program back in 2017. A little over 50 companies have come through the program. I think we're up to 29 companies now that are funded, and a little bit over $70 million that these companies have raised, partly directly from us, partly from people that we put them in touch with, or folks that they've found and we've helped them coach them through. Some of the companies that are in our current cohort right now, you see their logos across the top of the screen. And some companies, if you're wondering what happens to those companies that pitch to us on pitch day, here are 4 that are currently in review with our investment committee. So it really does work. These companies aren't admitted yet, but we're going through the process of working with them to see if we can make an investment and get them in the program. And then finally, in terms of the big deal that comes out of AngelNV is a $200,000 investment for one of the companies that applies. Hopefully that'll be some of you. And the way that it works is you apply. Our deadline for application for the AngelNV Seed Fund, which is going to provide at least a $200,000 investment to at least one company, is due by January 18th. So get your application started by January 18th. You can see that really complicated URL there, where you can just scan the QR code and it'll connect you to the website. Go through the process of putting in that application. You can also link to it from angelnv.com. And there's a $29 donation that we ask for to apply. If that's a hardship, send us an email, let us know, we'll give you a code. It does go to a nonprofit, so if you can't afford the 29 bucks, it helps us in our program. But if you can't, we don't want that to stop you from making an application. So do make that application between now and next week. At least get it started. You'll have a couple of weeks to work on it. Once you get your name and your basic information in there, you can revise it. The whole thing doesn't have to be done by January 18th, but you have to start it by January 18th. Our angels are going to start to look at those applications on February 2nd. So, you have a couple of weeks to get it done, but make sure you get it started by January 18th. Our accelerator program, the one that comes with $50,000 investment, you can go to StartUpNV.org and you can't miss it. We solicit you like 40,000 times when you hit our website to pitch to us, pitch to us, pitch to us. You can either click on that, or you can go to this URL, or just again scan the URL or scan the QR code, and it'll take you right to the website. So hopefully we will see many of you in AngelNV or applying to the accelerator, and there's no cost to apply to the accelerator. So please join us there. We're anxious to see our community succeed, and we do invest real money in these companies. All right, so that's the introduction. I'm going to start the presentation. Normally, at this point, I would introduce our speaker, but since I am your speaker, I'll introduce myself and I'll get going. My name is Jeff Sailing. I am a co-founder and the executive director here at StartUpNV. We're a nonprofit startup incubator and accelerator program for the entire state of Nevada. We've had some good success helping founders and their startups here in Nevada, and our mission is to really grow a robust and inclusive startup ecosystem here in Nevada to help diversify our economy and generally do good works. Tonight, the topic is investment terms and terminology. So we're going to talk about all the sort of funky language that goes along with making a deal, making an investment in a startup. I'm going to be talking about it a lot from an investor's perspective, but I'll be putting on both my investor hat and my founder hat from time to time throughout this presentation. So just so you know, from my perspective, while I do generally sit on the investor side of the table at this point in my career, the things that I'm working on with AngelNV and StartUpNV, prior to doing this, I spent almost 30 years on the other side of the table as a founder and an early stage startup executive in 3 companies that went through to an IPO, another one that got acquired, a 5th one that is still working, and 2 others that didn't make it. So not everyone makes it, and that's okay. So what is a term sheet? Well, when you do get to the point where an investor is going to make an offer, usually you talk about it first. And all that stuff that you talk about gets reduced to a term sheet. It's non-binding. It's just a summary of the deal. but it's a really great way to start off the conversation. So it's really a way that you document the basic terms and conditions of an offer. Everybody signs it, but there is no legal basis for it. If somebody walks away, either side, no one can sue anybody, but it does give you a good firm place to start. So there's a few different common investment types. The one that most folks you hear about most is preferred stock. You'll hear this talked about as a priced round. This is where you're selling actual stock in your company, and a preferred stock round is senior to common stock, and it generally comes with some special conditions that give you more rights as an investor than a common stock holder does. It's not senior to debt, and these other two things that I'm going to talk about in a second, convertible notes and safes, are things that convert into preferred stock. That's the place everybody wants to land before, as you're raising money. You eventually end up in a deal that is done with preferred stock. Most C deals.
If you're not sharing your slides, I'm not sure if you're doing anything back.
Come off here. Okay, are we on board now?
Yep.
Excellent. All right, so preferred stock, all that stuff I just talked about, you can see the page form right there. Sorry about that for the online folks. Like I said, it's the preferred stock is where all deals end up. There may be a stock in between at a convertible note or safe, but preferred stock is where you generally end up. See, most deals that are done at $500,000 or above go straight to preferred stock. Some of the deals that are done at less than $500,000 stop at one of these two places before they get to convertible from a preferred stock round. Convertible notes and safes, which stands for a simple agreement for future equity, are usually the very first kinds of equity deals that are done with early stage startups. The reason that they're done that way is it's really hard to establish a value for a company that maybe hasn't sold anything yet. There's really no proof in the market for. So rather than arguing over, hey, I think my company's worth $1 million or $5 million or $20 million or whatever you think it's worth, you can use a convertible note or a safe to sort of bridge the gap between where you are and getting to a priced round. So a convertible note is a loan, it's debt, and its original intent was for founders who knew they were going to raise a price round in, say, 9 months, or they kind of had somebody that said they were going to do a deal, but you need cash between now and then. So you would put together this bridge loan or convertible note, which will eventually convert into preferred stock, but usually it comes with a discount and an interest rate for that loan during the period of time that that loan is out before it converts to preferred stock. Generally, it'll convert to preferred stock at exactly the same deal, less the discount, to whatever that preferred price round is raised in. A simple agreement for future equity, or SAFE, is very much the same as a convertible note, but because there's no interest rate, because there's no specific term to it, it's not considered debt. It's the invention of Y Combinator in, I think, 2012 or 2013. But from a practical perspective, from a founder's perspective or an investor's perspective, other than the tax advantages and some of the other reasons you would do it and how it's accounted for, it serves the same purpose of being the short-term vehicle that gets you from the very first discussions until you can get to a point where somebody is willing to put a price on your company, and then everybody converts into that price. These earlier stages of investment, you generally will give a discount to the person who's putting the money in. So if your price round is for a valuation of 2, 3, 5 million, typically you're given at least a 20% discount to the people who are coming out of convertible notes. So that's the 3 most common types of investments that we have: convertible notes and safes, along that convert into preferred shares. So that's, if you take nothing else away from this session tonight, then take away those simple facts. So a few of the kind of common terms that are involved in convertible notes and safes. So always you're going to have How much is it for? Is it $100,000, $200,000, $1 million, whatever it is? Whatever the discount is at conversion, the most common discount that you give is 20%. I've seen it range from 10 to 33% to 10%. I'm sorry, 20%. It's unusual to give more or less than 20%. There's usually a valuation cap placed on in terms of this, meaning that this is the most that the investor will pay for the company, or the company will be valued when they actually convert their SAFE or their convertible note into equity. So you'll hear people talk about a convertible note or SAFE at, it's a $1 million convertible note on a $5 million valuation cap with a 20% discount. So that means that you cap the value at $5 million. So even if you raise a price round at 10 million or 20 million or 100 million, the most the person you've given that convertible note to and SAFE to is going to pay as if the valuation is 5 million. So it's an important number. It's only meaningful in the context of helping the investor to sort of, because they're early on, if you do happen to catch a runaway, something that's created a huge wave it jumps in valuation in a huge way, as an investor very early, you get a big advantage from that. Doesn't make a whole lot of difference from a founder's perspective, but it does make a big difference from an investor's perspective. Some other things you will see in convertible notes and SAFE are things like Prorata rights, which means that the investor will get to maintain a percentage of the company that they own, as long as they're willing to pay the price that's been offered in the round. So if you own 5%, you can maintain that 5%, but not at the full price, but at the new price. So you have the right to do that. And if you do catch one of those runaway companies that go skyrocketing in value, you'll usually try to scramble to raise the money so you can maintain your pro rata rights. A couple of other things that are definitely in SAFEs is a most favored nation, or you refer to as MFN, which means that if you do another deal that's better than the deal that you did with the person you just signed a convertible note or SAFE with, they get that same deal. So it's a way that for investors to protect themselves from somebody else getting a way better deal, 6 months down the line. Pretty common to see this. There's also round limits and redemptions, redemption terms in there, meaning that you can't convert a convertible note or a SAFE unless you raise around $350,000, $500,000. So you can't run to your Uncle Joe and convert a $1 billion valuation for $100, meaning that the convertible note or SAFE investor would be, really put in a bad spot that way. So they'll create a limit to the round, saying it's got to be at least this amount, otherwise it doesn't convert. The other terms that are common in convertible notes, these can't be in SAFE, is a term. Convertible notes will always specify a term. Typically, those are 18 to 24 months, enough time for the founder to raise another round, but not so much that's going to go on forever. And convertible notes also have an interest rate. Usually, it's 5% would be a low rate, 10% would be a high rate. It's usually somewhere in between there. Usually that interest rate you don't pay, as a founder, you don't pay cash on that interest rate. It just converts to more stock for the investor. So these are all common terms on convertible notes and SAFEs. Preferred stock, this is where it's going to get a little complicated. So there's literally 30 slides on this stuff, with one slide for each of the things you see on this summary slide. We're not going to hit all of them. We'll hit enough of them so that you'll get an idea for the most common terms and conditions. And then we'll wrap up and get into questions, so you can ask specific questions about any of these terms, or just in general this time. So generally speaking, your preferred stock is divided up into economic terms and control terms. The economic terms are some of the things you see here. What's the valuation? How big is the option? Is there preference? What happens if you have a down round in terms of dilution? Those kinds of things. Control terms are board seats. They're things that allow the investor to help have control over the company and some of the decisions that are made. So we're going to talk about them in those terms, economic terms, in control terms. So deal economics. So the size of a round, how much money is the company raising? So just to give you an idea of usually where the money comes from and who's providing the funding for these kinds of things is clearly when somebody starts a company, they're going to put some money in it themselves. Sometimes they put little to no money in it. And sometimes they put millions of dollars in, depending on what your place in the ecosystem is. So, self-funded founder funding, there's lots of people putting money in. The next stop on that train usually is friends and family. Those are usually pretty small amounts, $5,000 to $25,000, about $50 million a year. Usually it gets put in around the United States by friends and family into founders companies. Incubators and accelerators, what we run here at StartUpNV and AngelNV. Typical check size for an incubator or accelerator is $250,000 or less. And you can see the average there in 2021 is the average investment from incubators and accelerators across the country was just a hair over $50,000 for about 6%, which implies a valuation, I think it's around $800,000 if you do the math. And a whole bunch of money, about $4 billion gets invested by incubators and accelerators around the country. Sort of in the same category as angels, individual angels, angel groups, funds, pre-seed funds, seed funds. We run a seed fund, a pre-seed fund at AntiDilution. Check sizes are usually between $100,000 and $3 million. A big $25 billion a year gets invested by these groups. And those from the angels on back down to the family and friends is usually your very, very earliest sources of capital. And it usually occurs in that order, where you run from your own money through friends and family to an incubator or accelerator, and angels, angel groups, pre-seed and seed funds. They're all kind of interchangeable with incubators and accelerators. But those are usually the earliest sources of capital. I'll stop briefly on Reg CF or equity crowdfunding. It's a new thing. It's become easier and easier to do. There's more and more money being raised that way. StartEngine and WeFunder are two of the more popular crowdfunding sites. A caution note to those of you who are considering crowdfunding. You cannot raise a Reg CF offering at the same time that you're raising money from angels, incubators, venture capital, or anybody else. It's a one or the other kind of thing. So if you do start a Reg CF offering on one of the platforms, just know that you'll have to finish it before you can raise money from one of these other sources. Doesn't mean you can't do both. Typically, the ones that do the best on the Reg CF offerings are companies that have something that's really straightforward to explain. Consumer products do really well, and other things that are super easy to explain. We have a neighbor here in the IIC in Las Vegas called Pilsen. They are a delivery service for a pharmacy, right? So you can get your prescriptions delivered to you at home. Pretty easy to explain. So they're doing it, they're in the middle of Reg CF. I said rats because we wanted to invest in them from FundNV. So we told them, hey, when you're done with your Reg CF offering, come back to us and we'll take another look. We were ready to make an offer before we started the Reg CF offer. So just be aware that it's an either or. You can't do both of those things at the same time. You can do both, just not at the same time. And then the next, the place that everybody mostly wants to get to is that Series A venture capital. A small venture check would be $5 million. They're in that $5 to $20 million range. Typically, venture wants to own at least 20% of your company. So you have to have a pretty good track record before the venture people will take you seriously. A lot of money gets invested in that every year, $500 million. In just the A round, over $600 billion if you incorporate all venture capital, which includes A, all the way up through B, C, D, F, all the way. There's almost an unlimited number of venture capital that you can go through. And they usually are not going to get engaged with you. They're not even going to really take you seriously unless you're doing at least $100,000 a month in sales of whatever it is that you're selling. But that's the rule of thumb. And some of them now are pushing that up closer to $200,000 a month before they'll really entertain even really looking at your deck or taking it too seriously. You can talk to them before that. And it is a good idea when you're starting to, when you've got momentum and you can see that you're trending to that $100,000, $200,000 a month top line sales, start having those conversations when you're 50 and trending upward, because it's better that they know you when you get there than it's the first time they're here. I'm gonna stop for just a second and suggest to Maggie and Logan, if you guys are seeing questions and you want to stop me along the way in the chat, just break in and yell at me and we'll answer a question or two along the way.
Sounds good. Looks like there's nothing right now from folks online.
Yeah, I'm just seeing the little chat number tick up. So, if there's something urgent in there, stop me because I won't be looking at. I don't have the window open.
So Jeff, is that microphone?
Is it on?
I don't actually think it is. I
Are we on?
don't hear that.
It's turned on. Maybe it's not plugged in. Maybe it's run out of time. Might be other tools. All right. Well, my voice is pretty loud. Hopefully, you guys are hearing me okay.
There's a little bit of garbling going on.
We're just going to try to put the microphone.
Logan, whatever you're handling, that is on.
Understood. Try now.
So hopefully that will make it a little clearer to hear me because the microphone's much closer.
I think that's better. Thank you.
Great. All right. So now that we've established kind of where you get your money, one of the very first things that you do when you're raising a priced round is determine the valuation for your company. There's something called pre-money valuation and a post-money valuation. Super easy concept. Pre-money is how much your company is worth before the investment is put in, and post-money is how much is it worth after the money is put in. So if you are investing $100,000, for 20%, the pre-money valuation is $400,000 and $500,000 the post-money valuation. So you end up with 20% of the company after you've invested your $100,000. So people get confused on this concept, not sure why it's super, super straightforward. Pre and post-money valuation, before and after the investment. Preference, hence the name, preferred stock. So the people who have this stock have preference, and it determines the order and the multiple of the payout before, when there is a liquidity event. So if your company is sold, whether it's for a lot of money or a little bit of money, the preference will determine who gets paid how much in what order. There are oftentimes multiples associated with preference, so that you as a preferred stockholder might get 1 times your money back before anybody else is paid, 2 times your money back. It'll be defined in the terms, but a multiple on preference is not at all unusual. There's 2 forms of preference: non-participating and participating preference. Non-participating preference is by far the most common. You don't really hear that people do participating preference anymore. Usually that comes in when the economy gets bad and things get tough. You start to hear more deals with participating preference. Well, let's cover non-participating preference first. So when the company gets sold, the person that holds non-participating preference has 2 options when that liquidation event happens. They can either exercise their liquidation preference, or they can convert their shares to common and just sell the common shares. So the way that works in reality is, if you are selling your amount, if you're selling your company for a low amount compared to what the valuation was invested, the investor invested in, they're going to take their preference. If you're selling it for a crazy big amount, they're going to take their stock and sell that. So how it works is, again, the example of somebody's investing $100,000 for 20% of your company, and they have a 1x non-participating preference multiple. If the company gets acquired, meaning that there's an implied, so 20% for $100,000 means that the value of the company is $500,000 based on what the investor invested. But things don't go well. You get acquired for $200,000. Yikes. So what happens? Does that mean they just get $100,000 back? No, it doesn't mean that. Actually, it does mean that, because they have a 1x valuation or 1x preference on their liquidation rights, which means that they can take their 20% at $200,000, or they can take $100,000 liquidation preference. If they actually sell the company for $500,000, doesn't make a difference. because if they had taken the 20% of $200,000, they'd only get 40,000, or they can get the $100,000 for their preference. At $500,000, it doesn't make a difference. It's either or 20% of 500 or $100,000, same. If you have a nice exit at $1 million, they have the choice of taking 20% of $1 million, $200,000, or their $100,000 liquidation preference. Clearly, they're going to convert to common and sell their shares for the 20% of $1 million or $200,000. So that's how non-participating preference works. When you have a multiple involved, it makes the math a little bit more complicated, but the principle stays the same. So it gives the investor two different ways to get paid back. Participating preference. This is a little sharky, so follow along closely with me on this. What participating preference allows the investor to do is double dip. They not only get their preference, but they also convert their shares to common. They do both, not an either or. So usually you only see this when the economy is tough or when the founder is in really a bind and they don't really have a choice. And I always question the investors that bring it up as to whose best interest do they have in mind. So if you do get involved in a deal with participating preference, just think. You should stop and think, even if what I'm about to explain to you from a math perspective doesn't make sense tonight, just know this is a big deal. I need to stop and get some help on this. So that same deal we just talked about, somebody invests $100,000 for 20%, implying a $500,000 valuation for the company. In this particular example, you have a 1x multiple and you have participating preference. So the company has not a great outcome. They are getting acquired for $200,000. So what happens? That means that with participating preference, the investor gets to take their $100,000 preference plus 20% of the company. So they're going to take 20% of $240,000 plus $100,000. So they get $140,000 back before anybody else gets paid, before the founders get paid, before any other investors get paid. So it's not a great outcome for the other investors or for the founders if you've got participating preference. You can imagine what it might be like if there was a multiple. So if there was a 2x multiple, this is a way that when you hear about founders getting wiped out, it's usually a combination of participating preference and full ratchet dilution, which we'll get to in a minute. So again, if you hear participating preference, just pause if it's not making sense to you tonight and ask for help. Acquisition of $500,000. So before that was same, not the case here, right? So you're going to get your $100,000 liquidation preference plus 20% of $500,000. So you're getting $200,000 back as an investor before anybody else gets paid, and leaving only $300,000 for everybody else. So you think, okay, well, this person owns 20% of my company, but they're actually getting 40% of the value based on participating preference. It becomes less of a problem when the numbers get bigger, and that's usually how the investor will sell it. It's like, hey, you're going to be a unicorn, right? When you get past that, when you get up to those kinds of levels, then having the multiples and the participating preference does not make nearly as big a difference. Although you can see that it does still make a difference even at $1 million. They'll take their $100,000 liquidation preference plus 20% of $1 million. So it's $300,000 payback for them on a $100,000 investment, leaving $700,000 for everybody else. Not awful, but also not great. So if you hear that participating preference, that should be sending off some alarms to double check. Option pool. It's the very next thing that we're going to talk about. So when you're setting up a startup company and when an investor is coming in, they're almost always going to insist that you set up an option pool for your employees if you haven't already done that. Employees, board members, other people that you're going to want to grant stock to as you build your company. The investors want you to fund that option pool before they invest their money. So pretty common size of an investment pool is 10%. Really generous ones are 20%. Really stingy ones are 5%. But generally speaking, they're going to say, hey, I'm going to invest $100,000 for 20%, $500,000 valuation. But I insist that you set up the option pool before my $100,000 comes in. So the way that works out is, there's no pool at all before the investment. So there's zero, the founders own 100%. If they establish the pool before the investment, that means that after the investment, the investor owns 20% because that's what they bought. But then the 10% pool comes out of the founder's share before the investor money comes in. Totally common. You're not being snookered. It's just the way things are done. If the pool needs to be refreshed at some point in the future, then everybody gets diluted a little bit. But at the beginning of this journey, the investors are going to insist that option pool be established before they make their investment. You can see what happens if you do it after. Then the founders end up with 72%. The investors who thought they were going to own 20% only end up with 18 because everybody gets diluted by 10% that was set aside for the employees, the employees that will be hired presumably with some of the investment money that's coming into the company. So just be ready to set it. You don't have to do it right now, but before you take on your first investor, just be ready if they ask you to create an option pool, to go ahead and do it. It's not a big deal. Dividends, that's a more complicated term. It's not very common, so we're not going to cover that. So we're going to talk about some management and control issues. So board seats. An investor investing in a preferred stock is going to ask for board seats. Depending on the size of their investment, the number of seats is going to differ. A typical board ultimately ends up in sort of a 2-2-1 split or a 40-40-10 split, where the investors have 2 board seats, the founders have 2 board seats, and they agree on that 5th board seat. Really common, or you'll have some other odd number of seats which are set up similarly along the way. As you add more investors over time, the bigger the rounds are, the more board seats that they insist on. So, but it's very common to give away board seats. So again, not something that should cause a lot of consternation or drama if the investors are asking for board seats. You should be thinking a little bit down the line for the next round of investors. Make sure you have an understanding of when the next round comes, what's the board going to look like. But you don't have to sort all that out. But if an investor asks you to set up a board where they control 2 of the seats, you control 2 of the seats as a founder, and then the 3rd and then the 5th seat is somebody that you mutually agree on, that's a good thing. And having a good, diverse board with many opinions and many disciplines on it is a good thing, and it helps you to succeed. Information rights, not going to spend much time on this one. Investors are going to want a quarterly report from you. Don't fight them on it. Give it to them. Founder investing in IP assignment. This is a really common thing, and sometimes founders will get bothered by this, but you shouldn't. So if you've owned you started the company, you own 100% of it, or you and your founders own 100% of it, and you're about to get, well, let's first deal with the IP thing. You developed some IP. Maybe you applied for the patent in your own name, and you have it personally. Your investors are going to insist that you, as the founder or founding team, assign that patent or that IP to the company. That's what they're investing in. Shouldn't be a big deal. It'll cost you a little bit of legal money to assign it over. If you as a founder fight them on that, red flags are going to go up for your investors. They're investing money in you, your company, and the IP if you have it. If you're a software company, you probably don't have IP. But if you do have IP or a patent, they're going to want to see you assign that to the company. Not something you should fight about. Founder vesting, a little trickier topic. And a new investor will come into the company and say, hey, you group of founders, right now you own 100% of it. I'm going to come in and I'm going to put a few $100,000 or a few $1 million into your company. And what we're going to do is we're going to reset your ownership, not to 0, but we're going to make you earn back the 70 or 80% that you're left with after I invest as the investor. And the way we're going to do that is you have that in voting rights, but you're going to have to earn your stock back over time. So they'll start the clock on vesting over a 2 or a 4 or a year period of time. And what that is designed to do is to keep you interested as a founder. And so that you don't get the money in the company and then go on vacation for 6 months, or don't stop doing your job and you already have the ownership in this company. They want that stock to vest over time, so you keep working in the company. So that's one reason. Another reason is if there's multiple founders, they want everybody to reset and start vesting their shares, because if one of the founders drops out, it puts the other founders under a lot of pressure, where the one person who's dropped out still maintains their ownership percentage because they were granted it at the time of the investment. And the other two are working their butts off, and a lot of resentment is created. And this happens more often than you would think when people don't think about this, where, it's a group of 2 or 3 or 4 founders. One of them just kind of loses interest. And if they aren't vesting their share, their 25, 30, or 40% share, whatever it is that one founder owns, is theirs. That means they're gonna drag you through the mud every time a decision is made. Everybody's gonna start resenting one another because that founder isn't working in the company anymore, and yet they maintain their ownership. So again, founder vesting, really common thing. It's not an insult. It's to protect you and the investors both. So again, it's not something that you want to fight on. It's something that's really common. And if you're worried about it, if you see it pop up and you want some advice, just reach out to us and we'll run through it in more detail. Went the wrong way there. Non-compete. Hey, if the investor insists that you as the founder, if you do leave the company, if they do have a liquidation event, or if you do leave the company under whatever the terms are, that you can't just come right back and compete with them for some period of time. Again, pretty common. Don't get a lot of fighting on that. So it's not that big of a deal. Other things that come in your deal, approval rights. It's something common. The board of directors are going to set policy, and oftentimes the founders are on the board, so they get to set policy as well. The board decides. The CEO works for the board. So they're going to decide the pay and benefits that go to the CEO and the other senior officers in the company. They're going to make decisions on big, usually there's a dollar amount set. If a decision on a purchase or a lease or something like that, it involves a certain amount of dollars or more, the board's going to approve it. So pretty common thing in there. Participation or pro rata rights. So this is really important. Almost all investors will insist on it. I alluded to it at the beginning of this talk, where if an investor if you buy in through a convertible note or through a safe or through preferred stock, and you own 20% of the company, and you're out raising your next round, investors want the right to maintain their percentage. Now, they don't get to buy in at the rate they did, where they invested 6 or 9 months or 2 years ago. Whatever that new round is priced at, they have the right to buy stock to maintain their percentage at the new price. Very common thing to do. The investors don't always exercise their pro rata rights, but it's very common to ask for it. We ask for it on every single deal we make, and we'll walk away if we don't get it. And what the reason you do that is, as an investor, if you do have a company that's on a rocket ship, and you hope all of them are that way, you want to be able to maintain your percentage so that when the big payday comes a few years down the line, you can maximize it. And the further down the road you get, the more sure you are of that. So even if you have to pay a higher price to maintain your percentage, you're willing to do it. But if you're not sure and you don't maintain your percentage, it's okay. But there's going to be other investors who are asking, what do they know that we don't know? Why aren't they maintaining their percentage? They have pro rata rights. Why are they not? Do they not think this is a rocket ship? So it's something to consider. And it's not something, again, as a founder that you should fight on, because most sophisticated investors will walk away if you don't give them the pro rata rights. Sometimes that causes fights between the investors when you're raising your second or third round, and the newest investor doesn't like the fact that the old investors are going to get to maintain their percentage. But that stuff gets worked out all the time. It's something that's normal, and you shouldn't have a lot of fighting.
Jeff?
Yeah.
Quick question, and if you're going to address it later, let us know. But there's someone in the crowd online asking, since they are an LLC, is that an obstacle to attracting investors? You can either address that now, or if you're going to address
I'll answer it now. It's a good question. It doesn't, I think it comes up later, but is being an LLC an obstacle to investing? The answer is yes. It isn't usually in the friends and family round, but when you're going to have a professional investor invest in you, they're going to do preferred stock, you have to be a C Corp. Most investors prefer Delaware C Corps. It breaks my heart as a Nevadan to say that, but it's just the way of the world. I'm going to work really hard over the next few years to change that as best I can through legislation and other policies that Nevada might have. Right now, we're number 2. But the problem is that Delaware is number 1 up here, and we're number 2 down here. And there's a giant gap between us as a C Corp. We actually have better protections for everybody in Nevada as a C Corp. We just don't have the court system and the history of lawmaking for it, that it puts us at a severe disadvantage to Delaware. But you don't have to run out right now or right at the beginning of your corporate or of your startup journey and do a C Corp. It's more expensive. It's harder to keep track of, but just be prepared before you raise a serious amount of money. Be prepared to change to a C Corp. Every time I've invested in an LLC, thinking, oh, we're going to do this later, it becomes a problem. Now we've just now set a policy as far as our investments is, we're not putting $1 in until they convert to a C Corp. And I know that most other investors feel the same way. So there's not a legal reason why you can't do that. It just makes the taxes, it just makes it way more complicated. If you're going to raise a serious amount of money, get ready to be a C Corp and be ready to convert before they'll give you the check.
What about
Question here.
What about an S Corp and then you don't do the election to then convert to C?
They're going to want to see you in the C Corp. Investors will. I mean, there are unique situations where that's not always the case, but 97% of the time, that's going to be true. If you think you have a special case, let's talk about it offline. But for the majority of cases, be ready to be a Delaware C Corp or a Nevada C Corp. Next couple of topics are biggies, and then we're going to probably race through a few more before we get to the end. Dilution. There's a couple of different ways to handle dilution. They're going to be covered one way or another in your preferred round. The most common way to do dilution is called weighted average. This never comes up unless you have a down round, right? Doesn't matter. But if you have a down round and you don't have dilution defined, things get pretty ugly. So the investors are generally going to insist on some sort of anti-dilution clause. So what happens in weighted average, and there's a formula on the slides. I'm not going to run through the formula, but what it means in principle is if your company was valued at $5 million, everybody bought in at $5 million, and you later have to go out and raise around at $2 or $3 million. That dilution that that occurs when your valuation gets cut in half, in weighted average anti-dilution, it's shared. It's shared on a pro rata basis between all of the investors that were in at the higher valuation. So usually that's a combination of investors and founders. And it's shared in a weighted average fashion, hence the name weighted average anti-dilution. It's a very common thing to do. If you do have weighted average anti-dilution in your preferred round, wouldn't be shocked about it. Do the math to make sure that you've got a good formula and that it's fair and it spreads the risk. But most folks who are offering this, the formula you see there is the most common way to do it. And you will want to define it. If you have no definition of anti-dilution in your preferred round, it would be really unusual, and it's kind of dangerous because you don't actually know what's going to happen in a lower round, in a down round. If you hear this term come up, full ratchet anti-dilution, this is just like the participating preference. All your alarms and bells and whistles should start to go off. What full ratchet anti-dilution says is that that the previous investors will bear the full brunt of any dilution, and that the new investors will own whatever it is that they own. So if you do have a down round, if your stock gets cut in half, your dilution from a previous investor's perspective can be almost complete if you've invested at a $500,000 valuation or a $5 million valuation, and suddenly a new investor comes in and puts in $1 million for 50%, meaning a $2 million valuation. All the money that you put in just got cut by 60%. And the founders get cut by 60%. Everybody who doesn't have this provision gets cut by that percentage. You hear about founders getting wiped out. You have a combination of full ratchet dilution and participating preference. You can go from owning 90% of your company to like 2 or 3% in one transaction. Again, another situation where you want to make sure that if somebody's offering you full ratchet anti-dilution, that you're doing the math, you're on alert. It's a sharky thing to offer. Usually it's only offered in a situation where the founder is perceived to be in a desperate situation. A lot of times that happens when the economy gets a little weak. But when you hear it, just be on guard. It doesn't matter if you're on a rocket ship. If you're going to be a unicorn in 3 years, it doesn't matter. This will never come up. And that's usually how it's sold. It's like, hey, you told me we're on a rocket ship, right? This thing's going to be worth $1 billion in 5 years. So what do you care? This only protects me as the investor on the downside. It's true. But man, if you have a downside, if there is a down round, you're going to get, if you don't get wiped out, it's going to feel really, really bad. So make sure that you understand the math on full ratchet anti-dilution, because you can get wiped out really quick. So, and just know that once you've offered full ratchet anti-dilution to one investor, everybody that comes behind them will insist on the same terms. So you'll never get out of it. First right. These are first right of refusals, pretty obscure. Right to block founder transfers, drag along rights, redemption rights. Again, these are all pretty obscure things. Redemption rights, not so obscure. I'll cover that, and you'll have all of these slides available to you so you can read through them. But I don't think that spending time grinding through all of them, given that we've already been at this for almost an hour, is probably the best thing to do. Redemption rights can essentially force a company or a set of founders to sell their shares, to exit the company. So again, it doesn't come into play very often. So if you do see it in your terms, just make sure you understand it, so that you understand what you're signing up for and what rights the investors are going to have to essentially make you sell the company or make you sell share. Registration rights, another kind of obscure thing. You've already seen me hold up the pocket guides for term sheets and startup valuation. I'm going to suggest that if you really want to dive deeper into this topic, start with the pocket guides and then move on to venture deals, which is sort of if the pocket guides are 101, venture deals I listed here as 201. It's probably more like 401. Just be prepared to grind through a lot of detail. Brad Feld's book is awesome, but it is kind of an advanced class. And if you're at all interested in sort of the history of venture capital and how we ended up where we did with all of this stuff, there's a great podcast, a Freakonomics podcast called "Is Venture Capital the Secret Sauce of the American Economy?" I think the one thing that jumped out, I learned a lot listening to that podcast. One of them is that venture capital started in the whaling industry back in the 1700s, when a bunch of lawyers and doctors funded the whaling expeditions in the northeastern part of the United States. And they would get outrageous returns if the ships came back and they had gotten a whale and all the stuff that comes from whales that was very valuable at the time. But about 19 out of the 20 journeys the ship crashed, people died, nobody came back. So about 1 out of 20 actually paid off. And that was the very first place where venture capital was started. And that's one of the reasons why it's got its history and its roots in Boston and in the Northeast, is because it was started on these whaling ships back before the United States was even a country. So that and then they run through a bunch of other history from there on up. And you would think, even being in this industry, that venture capital, it must be worth like 20, 30, 40% of the overall economy. It's about 1%. About 1% of the economy is driven by venture capital. It has an outsized impact on the economy because it does fund these companies to just become ginormous and have impacts on all of us. So it's I don't know, makes me proud to be part of it, both from a founder side and from an investor side, to have that big of an impact and bring that much value to the economy. So it's a good podcast. And now we're going to jump into questions. So if there are questions, I haven't confused you totally.
I think you have.
Okay.
There were not a lot of questions added into the chat.
This topic tends to be that way. It gets very specific on your particular situation, which is why I encourage you to get the books. I do this topic once a year for my college class, once a year for the founders, and then another time for our angel investor group. And usually I get that's a lot kind of look. So no worries.
So I would say the main point that everybody should be taking with them is, if you're given a term sheet, even if it's from friends or family, you should probably talk to somebody about it. I mean, we've seen sharky relatives.
Oh yeah, there was just in the brief conversation that we've had tonight, you remember what I said about participating preference and full ratchet? We had a founder in our program. We've had this talk. It's like having a talk with your kids about the birds and the bees, and planning your family and all the rest of that stuff. It's like, we had that talk. And yet the founder came back, was so proud he had raised $500,000 all on his own from family and friends, who apparently were sneaky lawyers because they put in participating preference with full ratchet with a 3x multiple on the participating preference. And it's like, oh, I don't know. You have no way of getting out of this. It was a good idea. Smart guy, a lot of experience in his industry. I felt really bad because it's like, you signed it, it's done. Unless you can negotiate them out of it, they've basically just stolen your company. It's just a matter of time before they close in on you. Unless you can get this thing like to a unicorn quickly, you're in real trouble. So smart guy, was explained to him. So that's why I said, you hear those terms, full ratchet, participating preference, alarm bell should be going off, you should be asking for help. We have, for all of you folks who are in Nevada, Southern Nevada, Northern Nevada, we have a few friendly legal people that work with us and with our founders. So if you get into a jam, you need to talk to a lawyer about it, just ask us. Whether you're in Vegas or Reno, not that it really matters, the lawyer, you guys are going to talk on the phone or by Zoom anyway, but we've got some really sharp folks that work with founders and understand this stuff. So if you don't know somebody yourself to talk to, just ask us, we'll make it through. Any other questions out there?
Haven't seen any.
Not surprising. Not surprising. It's that kind of topic. As much as I try to make it interesting and talk in an excited fashion, it's still pretty boring. So then we are on the hour, which is generally what we promise, an hour's worth of conversation. So if there's no questions, I'm going to, again, thank our sponsors, City of Las Vegas, Brex Card, and Glassboard Technologies. They're awesome. And if you do get a chance to make use of them, please do so. They support us. We should support them. Our pitch, the pitch for the competition for the $200,000 is the deadline for that is this time next week. I'm going to share the QR codes and the URL one last time so that you can.
Office hours on Thursday. The same link here, the same Zoom link. It's open to anybody. You can come with your questions and we will try to help you figure stuff out. And that is all about the GUST application. Starts at 5:30 and same Zoom link.
Yeah, just log in to the Zoom link. Everybody, it'll be it won't be a webinar like this, so everybody will just be able to talk. And you can just ask your questions. I will warn you that the GUST application, the GUST platform is a little kludgy. It's not my favorite platform. So if you go to the GUST platform, that's how we do it. It allows us to share your information amongst a group of about 50 investors. So we haven't found anything that's better for sharing that. So if you are interested in that $200,000 investment, jump into either follow that gust.com and search for AngelNV2 or scan that QR code, or just send us an email. If you're like, I couldn't copy that down, I fat fingered something, send us an email. We want you to apply.
Well, I put it in the chat, but we'll make sure that when Logan sends out the video of tonight's session, he'll include the GUST link as well.
Right. So apply for the AngelNV Seed Fund. The angels start looking at applications on February 2nd, but at least get the application started by the 18th. And if you get stuck, ask us. Like I said, it's not my favorite platform, but we haven't found anything that does a better job. So it's worth it for 200 grand. And I'll give you this other clue. Last year was the same program, right? $200,000 to one company. That's what we promised. Last year we raised $330,000 and we invested in 3 companies. So we set the minimum bar at $200,000 for one company. But we expect to exceed that this year. Can't promise it, but we do expect to exceed it this year. And I'm hoping that we'll get some matching funds from one of the government programs we're working with, so that 200 could easily turn into 400 or even more. So it's a big deal, and we hope that you'll apply. And if you are interested in joining the accelerator, we do, again, a $50,000 minimum investment. About half of our investments in 2021, we put our 50 in from Fund NB. We went back through our LPs, our investors, and said, hey, we're putting 50 in. Do you guys want to jump on board and put more in? About half the time, we raised more than $50,000. We've raised as much as $875,000, and of course, as little as 50, but it's somewhere in between is what the accelerator ends up paying when companies get in. Any other questions, Meg?
I'm not seeing any more questions. I'm seeing some appreciation and thanks. And we should ask Logan if he has anything he would like to add.
Anything you would like to add, Logan?
No, nothing to add on my end, everyone. I will be sending out those resources and a recording of this session, so you can have it as a reference. I know there's a lot to go over. And then, of course, please tune in Thursday if you have questions regarding the application. And again, to Jeff's point, if you guys have questions, just shoot us an email. We're happy to respond and help as best we can. And we look forward to seeing you guys' applications and seeing you guys in our community. Thanks for tuning in for the sessions.
Yeah. Oh, hey, any of you guys that want to stay around for the test? It's full essay, no multiple choice. So again, thanks everybody for coming out and grinding through what is a full of math topic.
You should put your email in there, but you didn't say it.
So you can reach me, Jeff at StartUpNV.org. You can reach Logan at StartUpNV.org, or Maggie at StartUpNV.org. You're probably getting the gist of who we are. And it's super easy to get to us on the website, StartUpNV.org. You'll find us. We aren't hard to find. We're on all the social platforms, well, except for Insta. Not much good for venture capital on Insta, but LinkedIn's our is where most of our activity takes place. All right, then, I'm going to bid everybody a good night And thanks for coming out, and the best of luck in AngelNV, our $200,000 program, and StartUpNV. So keep on making new companies and improving your own personal economy and the economy of our whole state. Thanks again.